Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 57, titled Evaluating Stock Purchase Price and Break Even When Rolling Out and Up. We're going to use a real-life example with Planet Fitness, Inc., which trades on the New York Stock Exchange under the ticker symbol PLNT. Now, the rolling out and up relates to covered call writing strategy, so let's start with a couple of definitions. When we roll our option out and up, we're buying back the near month short call and then selling the next month's higher strike. So, for example, had we sold the June 50 call, we roll out and up to the July 55 call. That's just a hypothetical example. Now that implies that the strike price is in the money, otherwise we wouldn't have to roll the option. Now the break even is the point at which the gains equals the losses. So as an example, when we're determining the break even on our covered call trades, we take the stock price and from that we subtract the combination of option credits and debits, and that will give us our break-even price point. Let's now turn to PLNT trades for the June and July 2019 contracts that was sent to me by one of our BCI members. So on June 3rd, 2019, PLNT was purchased at $75.58. Right after the purchase, the option was sold. The 75 in the money strike was sold for $2.70. Now, on expiration Friday, which was June 21st, PLNT was trading at 76.01. So $1.01, the strike was $1.01 in the money. No action was taken. Shares would be sold at $75, the contract obligation. So instead, the short call, the 75 strike, was bought back for $1.10. Now keep in mind, of that $1.10, $1.01 was intrinsic value. The amount that the 75 strike price was lower than current market value of $76.01, leaving only a time value component of 9 cents. Now, on 6/21 expiration Friday, the July 77.50 strike was sold for $2. So the contract was rolled out from the June to the July contracts and up from 75 to 77.50. Now, if we took a look at the stock cost basis and break even on June 3rd, when the original trades were entered, and enter it into the multiple tab of the Ellman calculator, we would see the following. Now, the information entered was the price of the stock, $75.58, the option strike of 75, and the premium of 270. So the ROE, or the return on our option, time value only, is 2.8%, and that's for an 18-day trade. Of course, there's no upside potential because we're agreeing to sell our shares at a lower price than current market value. Now, we do have a slight bit of downside protection of 0.8%, which means that Planet Fitness can drop in value by 0.8% over the next 18 days and no more, and we still will have generated that 2.8% 18-day profit. Stated differently, it can drop from 75.58 but no lower than 75 to guarantee that 2.8% profit. Now, the break even is the price of the stock, $75.58, minus the entire option premium, $270. That comes to $72.88. That is our break even at that point in time. So that's the information gleaned from the multiple tab of the Ellman calculator and represents the initial structuring of the trade. Now let's fast forward to June 21st, expiration Friday, and we here use the What Now tab of the Ellman calculator to calculate rolling out or rolling out and up calculations. In this case, we're considering rolling out from the June 75 and up to the July 77.50. Now, the proceeds from the 77.50 strike is $200 per contract. The cost to close was $110 a contract. That left a credit of $90 per contract. Now, in addition to that, our share value is no longer worth 75, which is our contract obligation before rolling. By buying back that 75 call, our shares are now worth 76.01. So they've gone up $101 per contract in unrealized profit. Unrealized because we haven't sold the shares. So if we calculate the net option credit of 90 plus the stock appreciation, unrealized as it is, of 101, that's $191 on a cost basis of 75, because that's what our shares were worth before rolling the option. That results in a 2.55% 1-month return. Now, if the price of Planet Fitness goes from 76.01 up to the new higher strike of 77.50, that would represent an additional upside profit of $149 per contract, meaning a total return of $340 a contract, which would represent a 4.53% 1-month return on a cost basis of $7,500 per contract. So for rolling out and up, we have a 2.55% static return if the price of the stock doesn't move at all, and a max return of 4.53% if the price of the stock moves up to the new higher strike price, 77.50. So rolling out and up decisions are based on meeting our initial time value return goal range. In my case, it's 2 to 4%. I'll go as high as 6% in a bull market for 1 month near the money strike prices. Now, let's take a look at our overall break-even point on June 21st when rolling these options. The shares were purchased at $75.58. We have option credits of $270, the original 75 strike sold, and $2, the new 77.50 strike. That's $470 per share. But we did have an option debit of $1.10 to buy back the original 75 call. So that resulted in a net credit of $3.60 per share. Now, the original purchase price was $75.58. So at that point in time, after rolling the option out and up, we had a break-even price of $71.98 when the shares were worth $76.01. We're in pretty good shape here with this particular trade as of June 21st when the option was rolled out and up. Let's summarize. When viewing our stock cost basis and break-even, there are actually two sets of calculations. One is used to make the best trading decision at that point in time, as we use the 75 strike as our cost basis, because that in fact was what our shares were worth at that point in time. We have to compare apples to apples. Should we allow assignment? If we did, we'd get $75 per share, $7,500 per contract. Or should we roll the option? Well, if we roll the option, we're comparing apples to apples, we have to use that very same 75 as our break-even or our cost basis. Now, the other is when we're viewing a long-term analysis of our trades, and in that particular case, our overall break-even would then be $71.98. So two sets of calculations. One is what we use for active trading, and the other is what we use when we're looking at our overall situation with that particular series of trades. As I always do, I want to mention to everybody listening to this podcast that we do have a myriad of free resources on the bluecollarinvestor.com website. Look at the top black bar for the free resources link, which includes the Ellman calculator as well as a put calculator. many other files that are for free. We have various videos, blog articles. If you go to our blog page, you could sign up for our free newsletter, which I spend hours a week working on, and you'll receive that newsletter every Sunday morning, 10 a.m. Eastern Time, and of course, it is for free. In the bluecollarinvestor.com store, we have books in 3 different styles: ebook, hard books for some, soft cover books for all. We have online video tutorials, online streaming DVD programs with downloadable workbooks. We have various calculators and spreadsheets, a trade planner, online mentoring programs, and much, much more. Go to www.thebluecollarinvestor.com/store. Have a look around, and we will describe all of these products in detail. So, ladies and gentlemen, that concludes this BCI podcast number 57, evaluating stock purchase price and break even when rolling out and up. So I hope you enjoyed this presentation, folks, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.